Hi, and welcome to the Michael Yardney podcast. Today I'm going to discuss a number of topics that should be of interest to all property investors with Mike Mortlock, Managing Director of MCG Quantity Surveyors. Mike's team has recently released a report about the rising tide of unit rents and how they're closing the gap with house rents in our capital cities. I want to get Mike's thoughts about this and some trends that are occurring, some shifts that are occurring, and some nuances in renter preferences. Also, we're going to talk about the growing concern that the government may look at changes to negative gearing and capital gains tax before the next election. And we're going to discuss the other side of the equation, the important role property investors play in our housing markets. So lots of interesting things to talk about. Let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome back, Mike.
Thanks, Michael. It's a pleasure to be back on the show.
Well, also I'd like to say congratulations for being elected as a new board member of PIPA, the Property Investment Professionals of Australia.
Thank you very much. Strap yourself in for a regime of terror. No, it should be good fun. There's obviously it's quite an old organisation now in the property space, and there's some really good heavy hitters on the board. And, we're at a time where I think property investors need a little bit of advocacy. So I'm hoping to help out with that and do some of the heavy lifting.
Well, the other voices on the other side of the investment world seem to have a much louder voice than investors and players in the property industry. So I'm pleased that you, Nicola McDougall, Kate Bakos and the others are part of that representing us. So thank you for giving your time voluntarily to do that. Now, there's a number of areas I'd like to discuss, and some of them will involve your thoughts on PIPA, in particular the concept of negative gearing and maybe capital gains tax as well. But before we get on to that, your firm MCG Quantity Surveyors recently released a report called Rising Tide of Unit Rents about closing the gap in our major capital cities. It shed light on how unit rents have been surging, in my words, skyrocketing. Maybe you could elaborate a bit more. What did you find out in this report, Mike?
Yeah, look, we sort of had a cut-off for different suburbs where we wanted to make sure that there was at least 100 sort of rentals normally available in that location. So we got that information from the ABS. And then, of course, we've been looking at rents from a snapshot point of view. What were they in February 23 compared to February 2024? And what we found is that the gap between houses and units, so as we sort of roughly know, houses are more expensive than units in the same location, and the rent kind of follows. But we've actually seen the growth in house rents nowhere near competing with the growth in units rents. So to give you a bit of an idea, the median rent in Sydney for a house was $650 Feb 23, and it grew to $700 in Feb 2024, so up 15%, whereas units went from $540 to $650, so that's up 20%. And that is sort of across the board, especially in the capital cities, where Melbourne was up 15% for houses, 26% for units, and in Brisbane it was 9% increase for houses and a 17% increase for units. So that was something that we kind of identified that we thought was an interesting talking point about what are we actually seeing happening here.
Okay, well, let me ask you, what are we seeing happening here?
What a lead in that was. I think,
Thank you for making my job easy, Mike.
Yeah, I know. You just put your feet up, Michael. I got it sorted. Look, I think what we're seeing is that the kind of mass exodus from the cities has pretty much reversed back to where it was. Like, of course, there will be some people that stayed out there, but the people that moved to the regions, it's not like everybody stayed. A lot of people had to get back to the office. We're also kind of seeing rents pushing so high as that we're having this kind of trickle down thing where people that would like to perhaps be in a house have been pushed into the units. The unfortunate sort of extension of that thought experiment is it gets to the point where there's people that were looking for cheap accommodation, cheap units that are really in a competitive space. And I think people are just kind of realizing that the price differential is such that, well, there's starting to see more value in some of these units, not just from rents, but from actual purchasing as well.
Oh, I agree with that. I mean, we know that, and you as a quantity surveyor would realise how much extra it's going to cost to build the next round of apartments that are just not financially feasible. We know the government wants us to build 1.2 million dwellings over the next 5 years, and we know that's almost very unlikely to happen. But currently, it costs more than the market's prepared to bear. But the cycle will move on. It always does. New units will be developed and eventually prices are going to go up. That's going to push up the cost of the value of established apartments. In my mind, they've already got quite some inbuilt intrinsic value. You can often buy them, well below replacement cost, can't you?
Yeah, absolutely. And if you look in certain pockets around the country, and you'll know Melbourne better than myself, but I was talking to a few people in Brisbane and they said that there's certain blue chip suburbs where the differential in price between a house and a unit is exceeding $1 million. Now, these are well located, established areas with good schools, with good amenities, and people are kind of really seeing, like, for investors, there's a great opportunity to get into this suburb with these unit purchases. Now, we're not talking about off the plan high-rise apartments. We're talking about those blue chip established, there might only be 8, 16 in that development. It's the sort of 40s, 50s, 60s bulletproof style build. There's a lot of value in those types of properties for investors at the moment.
Well, interestingly, one came across my desk or screen. I guess nothing comes across my desk anymore. A couple of days ago that our team bought in Randwick in Sydney. And I had a look at the floor plan, and it's 3 bedrooms. It's got a lounge and a dining room, so 3 bedrooms and a dining room and ground floor, so it had a little bit of a yard as well. That's what I'd call a family-friendly apartment. We know that Randwick's close to the CBD, close to the university, close to a whole lot of amenities. And when you looked at the price of that established unit, yes, it needed some doing up. It had extra upside potential of renovating it, but also you just couldn't replace it. It was virtually, if you took the block of land in Randwick and divided it by 8, the number of apartments, it was almost a land value, Mike.
Yeah. And that's where you kind of see, look, the building has marginal value, if any. It's really just that land there, right? And, when we talk about house to asset ratios, people kind of think, well, housing's the way to go, because traditionally that's where you get your more bang for buck in terms of the land holding. But in those apartments, they're on rather large blocks, and yes, you have to split it into eighths, but you're still getting a big portion of land at a price point that you can't get anywhere near a house. So it sort of begs the question, should you be spending $2 million on a house, or should you spend an $800,000 unit? And are those assets going to perform side by side? Well, I think units are bridging that gap a little bit at the moment.
One of the challenges when we look at units is that there are high-rise apartments, the sort of family-friendly, old-fashioned ones like we talked about a moment ago, townhouses, villa units in some states as well. So you can't lump them all together when you see these big broad brush figures of what a house rent is in Sydney, and you said it was $750. Well, I bet you that's not in Coogee or Bondi or Double Bay, is it?
No, those sorts of prices won't get you anywhere near it. And as you know, the median is limited in value because you've got to look at the price segmentation, especially from a housing value point of view. It depends on what's selling. Is it the top end of town that's selling, or is that sort of sticking? So that can kind of influence the numbers. So it is a bit of a broad thing. But yeah, that sometimes broad is great because it can tell you a macro story, and it does seem to show that the unit rents are really starting to grow at a faster rate than the houses. And I think that speaks to the different kind of demographics, the different lifestyle needs, but also affordability. The cheaper end tends to gallop along a little bit faster than the top end because there's more capacity to grow. Whereas people at the top end of the rentals, like, how much more can they afford to pay?
Well, I guess it also depends upon how you want to live. And so some people are choosing to trade backyards for balconies and courtyards and live in the right location. I think COVID brought that to a head when we realised how important neighbourhood is. And those lessons haven't been forgotten, Mike.
Yeah, absolutely. I think all those things have made a bit of a dent into what we want as individuals and what is kind of attractive from a housing point of view.
Well, we also know that we've had record number of immigrants and they're coming mainly to our capital cities. And for the first 3 to 5 years, they tend to rent. I don't know. Do they rent houses in the areas where their countrymen are? When they come here, they don't know a lot. They know where their job is. They maybe know where the university is, and others know where the people from similar countries or cultures live. What do they rent, houses or apartments?
Yeah, look, I think it speaks to affordability. I think they like to have houses where they can. Their household formation rates tend to have more people per dwelling than say, born and bred Aussies would, whatever that sort of term means today. But, it's funny, isn't it, when people sort of talk about, they come to Australia and they find their communities and we're kind of like, well, they should maybe integrate a little bit more. But then you go to London and you go to an Aussie pub and it's full of Aussies. You're like, okay, well, that's not dissimilar to what we like to do. We like that familiarity. And if you come to a new country, you kind of want to have that community, that support mechanism. So I don't begrudge people for setting up those communities.
Not at all. And they all come here with the aspiration of buying a home. That's part of the reason they come to Australia. What I see is currently they're pushing up rents, but that's also, they're going to be the people that in 3, 5, 7 years' time are going to be wanting to buy apartments or houses in particular because of the age group they're at. So that's one of the many factors going to underpin our property markets over the next couple of years, Mike.
Oh, yeah, and typically they will always rent, not always, but for the first couple of years, that is the standard model. They will come and rent, and of course, if you're moving to a new country, you don't want to necessarily buy straight away. You want to get a lay of the land. Where are the good areas? Where is my employment going to be? You want a little bit of safety and security. You don't want to be locked into a certain location. So, yeah, it does have implications for the housing market because these people will exit the rental market, and right now they are exacerbating rental prices. But I think it's important to note that we already had a shortage before we saw this immigration uptick. So they're not necessarily the problem. The problem we really had as a country is record low unemployment. We needed people to fill the jobs, right? We had, restaurants and cafes saying we don't have people to wait tables. We can't open the doors sort of thing. So we actually desperately needed immigration. We got hardly anywhere near enough of a construction workforce, for example. But I think not enough thought was put into, okay, well, these people are here to solve a problem, but where are they going to live? It has exacerbated the problem, absolutely.
Well, we know that government, as we said a moment ago, are encouraging new development, and in particular, it's going to be apartments. That's the only way you can do it in bulk. One of the challenges I hear a lot of investors have with investing in apartments is they're concerned about strata fees. You mentioned that in your report as well. Any thoughts on that that investors should be watching out for?
Yeah, look, I think you just need to go eyes wide open. You need to understand what the strata fees are. You need an independent expert to look at things like your sinking fund or your capital works fund and make sure that it's adequate. And units have really declined in popularity. We go back to 2018, 2019, around about 50%, it was actually 46% of our investors went into units rather than houses. You bring that back to 2023 and it's only 16% of investors buying into units. And what is the reason? Well, it's not necessarily affordability because we saw a lot of that stuff pushing people over into WA. So WA has seen a huge increase in property investment, and that's mostly houses. But units have been on the nose for a number of different reasons. You might remember a couple of years ago, we had the Opal Towers and the Mascot Towers. We had people being evicted on Christmas Eve with defects. In Victoria, we've had the flammable cladding issues, which is not just a Victorian issue, but that was probably the epicenter of it. And, during COVID, we saw huge vacancy rates in apartments. It was only relatively short-lived, but we're talking double-digit vacancy rates. So one time as a tenant in Victoria that you had some bargaining power in the last decade, right? So for all those reasons, I think units have become a little bit unpopular, and the pipeline of new sort of high-rise construction is a lot lower than average, and I think that's because there's quite a lot of development risk in those projects. They happen over a long time frame. The finance market at the moment is not necessarily conducive to developers financing these developments. So unfortunately, there's no real respite in sight for housing affordability and certainly rental affordability in that unit market.
There's no insight at all. And it's a shame that we're seeing people form tent cities or not being able to live where they want to live. But it's something that's crept up over a number of years as opposed to something happening suddenly. And again, one of the challenges is people are blaming investors for that, the ugly, greedy investors buying these units so that first-home buyers can't get in. Maybe that should lead on to another thing I'd like to discuss with you. In your new role as a director of PIPA, you're going to have to support the interest of property investors. And one of the concerns many investors are facing is the government, or not the government, the talk about scrapping negative gearing. The Greens in particular cast this tax break as the source of all the problems, from spiralling house prices to rental supply issues to rising rental demand. And the Albanese government is currently denying. They're saying that they're not going to change any of the tax laws, but there's concern in the back of a lot of investors' mind that maybe with an election coming up and housing affordability being an issue, that they may change their mind. What's your perspective on the argument that negative gearing is a tax break for the wealthy as opposed to being a benefit for everyday investors?
In essence, it's rubbish. I think the higher your income, the higher the marginal rate. So the losses are more valuable to you, right? But that's only because you're taxed more in the first place. We know from the ATO stats that the last ATO stats, which I think was 2020, 2021, there was essentially a break-even point. There wasn't the investor losses that we've seen in previous years because we were at record low interest rates, right? So most properties were kind of paying for themselves. Now, as we get those tax stats coming each year, and they are always annoyingly sort of 3 years behind, we will see those negative gearing losses increase. But people talk about negative gearing as a loophole. Now, as far as I'm aware, it was established in the 20s or 30s. There's not many loopholes that have been around for 100 years, right? But it's the same for every asset class. So if you own a business and you make a loss, then you can deduct against other gains, right? So it's not a property thing. It's just a structural part of the tax system.
If I was to open a Jim's Dog Wash franchise, for the first year or two, I'd have to buy the business and I'd have to buy a trailer, and I probably wouldn't make money until I built up a bit of momentum, and I'd be able to write that off, as do people who've got other businesses as well, so or shares, other investments. It's not just a property thing, as you say.
Yeah, absolutely. And I think the issue is that investors have been demonized in the last 2 election cycles. I mean, we had 2 elections really on this negative gearing, CGT scrapping stuff. And of course, the Labor government has ruled it out. But a friend of mine let me know that they also 31 times said that they wouldn't change the stage 3 tax cuts. And they did sort of give that a little bit of a tweak. So I think we're right to be worried about it. But I mean, property investors contribute a lot in taxes as well. I mean, across all property, we're talking about $1 billion a year. We're talking about nearly $1 billion a week for the states and territories on stamp duty. Now, not all of that is investors, but when it comes to land tax, the majority of that is going to be investors. And of course, If you take all of that away, investors are performing a pretty important service, and that is essentially housing 91% of all of the private rental accommodation market is private investors, right? So without investors in the mix, we have a huge problem that can't be solved in a short time. Like, the government owns around 30,000 rental properties. Well, that's going to need to increase by a factor of many in a short term if we do decide that we don't want investors to be in that housing space. But at the end of the day, no one really gets into investing in property to make a loss, right? The investors have to pay for that loss, and they get a portion of that back as a deduction. But, they're putting roofs over people's heads and making it more onerous. We can actually see what's happened. We saw with the Queensland land tax change, we saw a 14% drop in investors purchasing in Queensland. So not just people buying in Queensland, but the PropTrack data was showing that people were selling. And we've seen quite an exodus of property investors around the country. Now, that is the real problem with rising rents, because if you look at the last 16 years, rents have underperformed inflation. It's just the rapid pace of change we've seen in that last couple of years that's really stinging people.
Well, I just got some figures from that last tax year that you mentioned, and that's the last one that the ATO tells us about property investors. And as you correctly say, they're supplying 2,843,000 rental properties around Australia. That's the way the Australian system works. That's the way the government has made it work, that private investors are providing this. Now, they're now encouraging build-to-rent investors, but that's only going to bring in 30, maybe even 50,000 properties compared to the close to 3 million rental properties around Australia. They provide homes for 8.5 million people. And we know that the average investor is your neighbour, my neighbour, policewomen, doctors, nurses, average people. They're providing accommodation for 1 in 3 Australians. And if you think about it, they are saving taxpayers money, because the government would otherwise have to fund rental accommodation. And what most investors are doing, because we know most never get past their first or second properties, they're providing for their financial futures. So if that does work, they're going to save the government billions of dollars worth of pensions down the track. But as you say, they pay taxes, $4.5 billion in council rates in the year 21-22, $14 billion in land tax, $6 billion in stamp duty. And yes, there's a capital gains tax exemption, $20 billion in capital gains tax. Mike, I've heard it say, the capital gains tax exemption, it mainly goes to rich, wealthy people. Well, if you happen to sell a property and it's made a couple of $100,000 a year, all of a sudden, whatever your income is, it's going to push you into the top tax bracket. So I think most people who pay capital gains tax, at least for that year, are in the top tax bracket. But you're old enough to remember the reason they brought in the capital gains tax exemptions way back in the old days, that your accountant at the end of the year had to account for inflation. In other words, if your property went up over the 10 years you owned it, they gave you a discount in your capital gains tax for inflation. It was just too hard to work out. So they said, let's just discount it by 50%, Mike.
Yeah, and it's the same rules for the share market as well. I think that's where we forget. I mean, there is one fundamental difference between housing as an asset class and say the ASX or shares, is that you can't live in your share, right? So it is important. We do need to protect the occupants, and we have all sorts of legislation, some of it positive, some of it negative. I think in general, the idea behind it is good, like the Victorian minimum standards and that sort of thing. It's just the rollout that was pretty mismanaged with that. So I think there is enough out there to protect the renters and protect those consumers. But at the end of the day, we've got to strike up that balance where it's actually disincentivizing people from participating in that rental market. And unless the government wants to purchase 3 million dwellings, they're nowhere near enough being able to house people that need that. And it's been the same for 60, 70 years. 1/3 of people rent for a variety of different reasons, like immigrants who tend to like to see where they're going to be and secure their employment, for people that are saving for a deposit, and that's one thing that I wanted to highlight with some of the recent issues around rental affordability is that it's very, very difficult to save for a deposit when you're renting right now at the moment. And that's something that I think is a national crisis if we still value home ownership as part of the great Australian dream.
Well, the government is going to be talking about affordability between now and the election next year. They keep having these think tanks and these ideas, most of them not practical. One is, okay, developers supply 1.2 million dwellings in the next 5 years, but they're not going to be affordable. Have you got any thoughts on how we could make property more affordable? Now, of course, one way the Greens and others are suggesting is just drop the price of properties. The government's not going to want 70% of Australians, those 70% who own a home, to suddenly make a loss on the value of their home, their castle. They're not going to do very well in the election that way. What other methods could they make property more accessible? And accessible may be a better word than affordable.
Yeah, and that's a good point. Look, I think there are always some good state-based policies around, stamp duty exemptions or 5% government guaranteed deposits and those sorts of things. I think it's important that those things happen. They tend to be stimulatory though, right? So if you are one of the beneficiaries of that and, the next first home buyer misses the cut, then things have just gotten a little bit more expensive for them. But I think stamp duty is a really inefficient tax. I mean, it's going to be worth $40 billion a year to states and territories, and it's the main driver of revenues in state economies. So they're absolutely hooked on the drug of stamp duty. But I think that could better be represented by a broader-based land tax or a housing levy. A few people have proposed, because it actually stops people from moving between properties that might be better fit for purpose. I think the best example is that quintessential little old lady who grew up in the family home. It's a 4-bedroom place. She's there by herself, but doesn't want to downsize into the next property because you've got to pay the stamp duty. So she's basically sitting in something that's not fit for purpose, and there's a family that's desperate for that space that's going to make better use of it. But because of that structural kind of mobility tax, that is a little bit of a problem. So, I mean, that's probably one example. I think we need to incentivize developers, perhaps from a security, from a finance point of view. We do need those high-rise developments. They can bring a lot of stock onto the market really quick. And, there's a few ideas in and around those things that I think could make a big difference. But in the short term, we don't want to be disincentivizing investors until there are other solutions.
Well, at the moment, investors are being a little bit wary, but this year we've noticed at Metropole more and more investors are wanting to get into the market, recognising that at some stage interest rates are going to fall. Maybe that's been pushed back a bit further than we hoped. We believe inflation's under control. But it was investors that drove the last large boom of new apartment development, local and overseas investors. And at the moment, we're really not seeing as many overseas investors buying into those off-the-plan towers to make them financially viable.
Yeah, and that's something that needs to be carefully considered. I mean, we do like to point the finger at overseas investors as the reason why housing is unaffordable or too expensive, or there's a housing crisis. I think the data points to them as having quite a minuscule impact, but they do tend to have a predilection for the brand new off the plan style apartments. And
they don't have a choice really. They can't buy established apartments or established homes.
Yeah, well, there you go. And I think it also speaks to some of the differences in culture as well. And anything that helps these developments to be built, I think, is a good thing, because, these international investors, they're almost certainly going to put this on to the rental market, and, that reduces some of the demand that we have in there. So I think there's a lot of different ways that we can play that. But right now, that 1.2 million homes in 5 years, that's due to technically start 1 July. We've only ever hit that pace of construction once ever, and we're asking that to be done 5 times in a row. And we also have just printed a decade low of new housing in the previous month. So it seems like it's over before it's even begun.
Well, and we're starting with a deficit, as you say. Well, you're going to have your work set out for you representing property investors as a director of PIPA. So I look forward to having further chats with you about that and see how you're helping us. In the meantime, you've also got a real job, Mike, and I know that you help our clients at Metropole, and this isn't a paid ad. I've actually had to pay for my depreciation allowances, the reports that you've provided, but maybe you can just tell us a little bit about what your team does.
Yeah, look, when it comes to property investing, we've just talked about all the reasons why it's a bit of a hard slog at the moment. So we like to be a little bit of a respite for investors. So essentially, properties that you buy, we estimate the construction value, the fixtures and fittings where they qualify, and essentially provide you with a deduction based on the fair wear and tear of the asset. So across all residential property, our average deductions tend to hover between that $9,500 to $10,000 mark. Now, of course, it depends on your marginal rate, but that could comfortably be $3,000 back in your pocket in the first year of claim. So that's just a cash flow bonus. People shouldn't invest for depreciation. It's a bonus, not a strategy, but it's a pretty solid bonus out there. And there's a lot of unclaimed deductions out there, and I'm on a bit of a mission to try and reduce that number.
Well, unclaimed because people don't even realise that they can have them. It's not only for brand new properties, is it?
No, exactly. And I think, when the rules changed on the 9th of May 2017, a lot of people didn't quite understand. They thought, okay, well, this depreciation game is over. But if you think about a property that was built in the 60s, for example, you're actually able to claim deductions based on the improvements made to the property. Now, you might have just bought it. You might not have done any renovations yourself. But if the previous owner has, and they're done after 92, then we can estimate the value of those works. So often we do see established properties having more deductions than brand new project homes. Just for that reason, they've been heavily upgraded and extended and renovated. So it's always worth asking the question.
Okay, well, I'll leave a link in the show notes to MCG Quantity Surveyors, and I look forward to catching up with you again in due course. Thanks for your time, Mike.
It's always fun. Thanks, Michael.
Well, that was an interesting chat with Mike Mortlock, and it'll be fascinating to see how things play out over the next year before the federal election, with the government and the Greens and various parties having their thoughts on how to fix the affordability crisis. If you got some benefit from today's show, but you don't currently subscribe or follow this show, just stop for a sec, and on whatever podcast app you're on, just follow the show, so twice a week you're going to get my regular updates with the guests I bring on. By the way, why not leave a review while you're there? And it would really be appreciated I'd really appreciate it if you told somebody about the show, just to get more people learning what these excellent guests that I like to bring on have to say. Now, in a moment, I'm going to share my mindset message with you, but I'd like to just follow on what we said with Mike Mortlock about the fact that there is a severe shortage of rental accommodation and no end in sight, which clearly means that rents are going to keep rising this year. But it's going to be a really interesting year because not only are rents rising, but also property values. Now, that's unusual. Usually rents rise at a particular stage of the cycle and values at different stages. But this year, both are occurring at the same time. As a property investor, I'm happy about that. Now, I'm not wanting to take advantage of tenants, but we know, as Mike said, that rents haven't gone up. Well, they haven't kept up with inflation for over a decade, so it's good to see what's happening at the moment. And I believe this year is a year where later on, as we realise that interest rates are going to eventually start falling and inflation's under control, the market's going to reset and perform very strongly in the second half of the year. But as normally happens at this stage of the cycle, the markets are going to be fragmented, which means, well, in my mind, probably only about 4 or 5% of properties currently on the market are what I'd call investment grade. This means many people are going to get into the property market, who are going to buy an investment, are going to sell up in the next 5 years. Look, probably 50% of purchasers are going to do that if history repeats itself. And of those who stay in the game, most are going to find their properties underperform, again, if history repeats itself. So how do you beat these terrible odds? I believe you make the right decisions by getting the right advice. Successful property investors understand that getting independent strategic advice is an investment, not a cost. The problem is there's so many people out there giving advice at the moment, aren't they? And they're telling you where to buy and how to buy and that they've got the right access to properties. At Metropole, we do it differently. We're much more than buyer's agents. We are big enough to tip the scales in your favour, but small enough to care. And we always start off by working out where you are. If somebody already starts telling you about their property or where you should buy before understanding what you want to achieve, my recommendation is run away very quickly. If you want to outperform the markets, why not have a complimentary wealth discovery chat with my team at Metropole? Just go to metropole.com.au and learn how we can help you outperform the markets, as we've been doing with clients for well over 20 years. Sure, we've got all the data, but more importantly, we've got the perspective to back up our recommendations, which always start with putting a plan together for you, helping you plan to become the people you plan to become. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to discuss with you the one thing that could make a huge impact on your life, on your future, on your financial future. Now, you may be familiar with this. It's a concept that I've got to give credit to for Gary Keller, who wrote an epic book called The One Thing. The essence is captured in what Keller calls the focusing question. Keller argues that the key to extraordinary success is focusing daily on the one thing. The thing that's most important to achieving a goal, rather than scattering yourself in many directions. Keller explains how to determine your goal or your life purpose and then focus intensely on getting there. In other words, avoid the pitfalls such as multitasking, relying on unprioritized to-do lists, thinking too small, misunderstanding willpower and discipline, and neglecting your personal life. Keller says that when you know and focus exclusively on the most important thing every day, everything else falls into place. Extraordinary focus on the one thing brings extraordinary success, according to Keller. And that makes sense, but I want to show you something different today. I'd like to ask you to consider the inverse of Keller's question. What's the one thing you do not do so that by not doing it, everything else ends up being more difficult or forever stays on your personal to-do list? Now that's scary, right? Sometimes we only look at what it costs to do something, and then when it seems too hard, we just don't do it. But when you turn it around and look at what it costs not to do something, we may find the price and the pain of inaction can be even worse. Now, I'm not sure what that would mean for you. Maybe it's being stuck in a job trading time for money. Maybe it's not having sufficient choices in life because you don't have passive income coming in because you haven't invested in property. Remember, you're never going to become rich if your money doesn't work for you while you're asleep. Or maybe it's just the frustration, the regret, or the envy for those who do have those choices and the passive income and have more. When you prioritize, so you're focusing on the right thing at the moment, everything after that subsequently seems to fall into place like a progression of dominoes. When you pursue your goal by starting with the one thing, the right thing, it leads to bigger things. You build energy. It's a geometric progression. To achieve success, I'm going to suggest you aim for the moon. Getting there is doable when you create that domino effect in your life. You see, a wealthy person doesn't become wealthy in a day. A champion athlete doesn't start winning on day one. Money, skills, expertise, and accomplishment, they're built over time. Success builds on success sequentially as you move from one thing to another until you reach the highest level possible. So work out what the one thing is you should be focusing on, but just as importantly, think about what the cost is to you, your family, if you don't do the one thing. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?